the end of the day, the reason we're all working as hard as we are is to create financial independence for ourselves and our families. And so to leave this money on the table when it's available is kind of silly. Hey everyone, this is Ali Oromchian. I'm the CEO of HR for Health, and I'm super excited to have Carson Henderson from Earned Wealth Advisors here with me. And believe it or not, it's your first podcast ever.
Very first one. So we hope it goes well today.
It absolutely is going to go well. It's going to absolutely go well. And so I'm excited this is your first one. But you know, what's I think really interesting and why I wanted you on this, Carson, is because you have a very unique role. You're a CPA / tax advisor,
Yep.
But you're also a wealth advisor. And what's interesting about that is you've worked with hundreds and hundreds of doctors nationwide, helping them not just with tax minimization, but with building their wealth. And so tell us a little bit about how you even got into that. Like, how did you mix those two things?
Yeah. I think, along the way, I became a CPA first, right? And really focused on tax planning and tax optimization, right? A doctor's single biggest expense through their career is taxes.
Yep.
You hear about whatever payroll or supplies. Yeah, those are big expenses. But ultimately, Uncle Sam gets more of your income than any of those other costs, right? So yeah, that's where I started. But through that, journey, we've learned that on that tax minimization, we can help somebody in their financial planning and their financial career, right? If we can save them a little tax, we can optimize their retirement plan. So really that they go hand in hand. You can't have, and really in the industry today, that's kind of what it is. You got a tax advisor over here and you got a financial advisor over here, but they don't talk. And so, if we could have them talk, we can help minimize taxes on stuff they're doing, on the financial planning side, but also on the tax side, we can help optimize, on the financial planning side as well. So it kind of goes hand in hand.
Absolutely. I mean, and by the way, for everyone who's listening, we're talking about tax minimization, not tax avoidance, right? No one's going to jail here. So, the IRS can turn off and don't have to listen anymore. But you're exactly right. I mean, it's saving on taxes is always on people's minds, right? Because the kind of doctors that we all work with, we're all blessed. They're all very successful, or they're younger in their careers and they're going to be even more successful. But to get to financial independence, it's not just about saving, it's about what you do with that money. Right? If it's sitting in a checking and savings account, you're not going to be able to build the same kind of wealth as you would do other things. And I'm going to get to that because I know you guys have some incredible strategies for this, and it's things that I think are really unique. People have heard about some of them, but they're very unique in terms of how you implement them. So I want to get to that in a little bit.
Sure.
But in the meantime, let's talk about the psychology of the doctors, because you've been doing this for, I think, 15 plus years now. Have you seen the psychology of the doctors change in the last 15 years from maybe how they were thinking of building wealth to maybe where they are today?
I will say the successful ones listen to advice, right? The ones that aren't as successful are the ones that kind of do it themselves, or are reading the blogs and seeing what other people are doing and not really listening to sound financial advice, right? And so I think it's really important to listen to your advisors. Like they're there, they've made their living by offering financial advice, right? So that's where I've seen the biggest impact. Is the clients that listen really are way more successful than the ones that don't. Yeah.
And I think what you said earlier is an important point that, with Earned, you have the CPA side and you have the financial advising side. And I know you guys are bringing in other services too, like insurance or whatnot. But if we just focus on the CPA and financial advising side, on the tax side, that is really important to be able to walk down the hall and be able to talk to your colleague and say, hey, here's what we can do. Where the clients, if they have two completely different advisors, maybe they're not necessarily getting on the phone. Right. And so do you see that really actually help?
Yeah, 100%. Yeah, I mean, there's obviously things we can do in the portfolio, on the wealth management side that will reduce tax liabilities, right? There's things that are inefficient from a tax perspective. Interest income, it's not very efficient on a tax side, right? If you're in the highest bracket, that interest income gets taxed at the highest rate.
That's right.
So on the financial planning side, right, or on the wealth side, asset location is key, right? You don't want all your interest-bearing investments in a taxable account. You'd rather have those in a tax-deferred account, a 401k, a profit sharing, right? The defined benefit plan. So we can do things, again, having that conversation that, hey, this person's in the highest bracket. Let's move assets instead of, in their savings or their brokerage account. Let's move those to the 401k plan. And, oh, by the way, we're doing charitable or, we're doing distributions, RMDs, right? This person's really charitably inclined. There's a better way to do those charitable contributions on a tax efficient manner. So yes, that conversation is happening, and it's important to make sure that those advisors are talking to each other.
And what I think is the reason I think this having everything under one roof really resonates with our doctors is because it's so much what they do in their practices, right?
Yeah.
I mean, that's where things are going, right? Today you have pediatric dentists that have orthodontists in-house, and you have general dentists that are working with different specialties, right? You have physicians who have different services. I mean, now we even have like optometrists that are partnering with med spas.
Right.
And, everyone's trying to get everything under one roof so that it's more convenient for the customer.
Yeah.
And what you guys are doing really at Earned is saying, we want to do that for the doctor so that you don't have to call 4 different people and coordinate. It's all there. And I think that's really important. I'll tell you a quick story that happened during COVID. And it's unfortunately not a super happy story, but I think it brings up the reason why what you're doing is so important. I had a doctor call me, and we were doing all these videos during COVID and trying to teach everywhere. Everything. Yep. Yeah, and it was we were really blessed that we had that platform to make people feel that it was going to be okay, right? Because it was such a scary time. And I'll never forget, I had a doctor call me, and she was 62 years old, and she said, Ali, I cannot retire. My CPA has said I have to work an extra 10 years. And I said, okay, well, walk me through that. I mean, I'm not a financial advisor, but walk me through why they said that. And she said, I've never been married. I don't have kids. I have a very successful practice. I'm doing about $1.2 million or so. I have some 401ks in my home, and that's it. And I said, okay, well, what happened to the rest of the cash? Because if you have that kind of practice, you're making a lot of money. Yeah. Where are you putting it? And she said, it's just sitting in my savings.
Oh, yeah.
And I said, look, I'm not a financial advisor, and I don't pretend to be one, but I do know some things. I do it for my own family, and then I see our other. You got to put this in something that's earning you, wealth and building wealth and whatnot. But that's a hard place to be. If you're 62 years old and your CPA is telling you got to stay on for another 10 years because you haven't done proper planning, man, that hurts.
Yeah.
And I'm sure you've seen these stories, right? This is one story that I was very closely experienced, myself. So, but do you see that?
Yeah, we do all the time. And that's the hard part. Those are the hard conversations you have when you're a financial planner, is as they're approaching those later years, the 60s, right? Is, can I retire, right? Do I have enough, will my retirement funds maintain my lifestyle? And so those are the tough conversations. The cool thing is that we're trying to have those conversations at younger ages, right? Yeah. So when they're in their 30s and their 40s, and saying, hey, when do you want to retire?
That's right.
You want to retire at 55? All right, this is what we've got to do today to set you up to be able to give you the chance to be able to do that, right? Obviously, there's unforeseen, circumstances that happen along the way, but let's plan for those. Let's make sure we've got contingency plans, et cetera. Yeah, it might set you back 5 years, but we already know that as we build that financial plan. I think it's really important to have those conversations early, don't wait until you're 60, 62.
And then try.
Right? Sure, you can get there, but it's going to take you some time to kind of get everything in place.
Yeah,
and set
absolutely.
up.
And I think people sometimes, I think everyone's heard the rule of thumb that advisors say, which is start early, right? Because you have more time to earn your money and whatnot. And there's some real powerful messages behind that, because if you're investing properly, not in super aggressive and not super safe, but just like kind of normal growth, your money should double every 6 to 7 years.
Yeah.
Is that about right?
I mean, it's the rule of 72. So you may have learned it in college, you may not have, right?
Yeah.
But the rule of 72 is whatever your return on investment is, right? So if you're earning 10% per year, you take that 10%, you divide it into 72, and that's how fast your money doubles, right?
Perfect. So 7.2 years.
7.2 years that your money should double. Now, if you're investing in, interest, right, and it's only interest bearing and it's 4%, that's, I don't know the math there. I can't do it in my head that fast, but that's maybe like 15 years, right? Or 16 years. So it's taking you a little longer to double your money.
Exactly.
So again, there's another wealth conversation there of, hey, how much risk am I willing to take?
That's right.
Or how much risk do I need to take? If I'm 72, I can't have all this in just interest, right?
No.
I've got to take a little bit more risk.
But when you're younger, right? Because you and I give a lot of seminars to younger doctors who are either in residency or recent grads or whatnot, and it's super fun to do that together, actually. But when we do those, if they're starting early, they don't need to put away $50,000 because they can't afford that, right? They're trying to save for a house, they're trying to pay their student loans, they're trying to do, they're trying to buy a new car because they haven't had a new car for 12 years, right? And so they finally want to spend, which is totally fine. But it doesn't mean you can't put aside, $1,000 a month, right? Because that 12,000, and I always say, it's not about the 12,000.
Right.
It's what does 12,000 in my example mean in your lifetime? Right. Because if that doubles in 6, 7 years and then doubles again and doubles again, that 12,000 could easily be, millions of dollars by the time you're ready to retire. And the reality is that I think people sometimes think they need more than they actually need to save. Right. Like I have some doctors that are like, I need to save $50 million. Like, no, you don't. Not unless you want to fly around in a private jet. So I guess let me ask you this: when you're giving these seminars to these younger doctors, right? How do you help change their psychology about investing? Because they do want to spend some of that money they've earned, and rightfully so, right? I'm the last person to say don't spend, because I think you have to enjoy life, right? We're here for a short amount of time. But how do you change our psychology?
Yeah, I mean, I just remembering back to the last time we were on stage together, right? Presenting to that residency group down in Newark, right?
Yeah, Newark, yeah.
But yeah, I mean, that's the slide basically is a slide with a picture of a bucket, a picture of sand, and a picture of rocks. So the rocks obviously represent kind of those big ticket items, which are, saving is one of those. You got to be saving every month, right? But it's the car, it's the house, it's all of the above. So if you're doing proper budgeting, right, you put the rocks in the bucket first. And then everything else falls in, the sand falls in, right? And you can fill that bucket, you can fill that budget. If you do it reverse and you put the sand in first, it's kind of an interesting phenomenon where you can't actually fit all the rocks, right? The rocks fall out, right? Which means you don't have a proper budget. And so you're setting yourself up for failure. I've got clients today that they don't plan on the tax payments. They're not making those estimated tax payments.
That's right.
And every year, it's this battle of how do I come up and make those tax payments? And these are people making a lot of money, right? So that, setting up the mindset of, budgeting, living within your means, it's all very important to set up the long-term success.
Absolutely. And we are not saying do not buy that BMW,
Right,
right?
no.
We're definitely not saying that. You got to enjoy your life. You've earned it. You've gone through school, you got debt. It's fine. Buy those cars, buy those things, but be smart about it and buy it in a timely way, right? But I think you're right. I mean, what you were saying about the buckets and the rocks in the sand, hugely important concept. Hugely important concept. Let's talk a little bit about the differentiation between an owner and employee, right? So a lot of people think they have to wait to become a practice owner before they can start saving. What are some strategies for those that are listening that are employees, right? They're young associates working for someone as, an employee or independent contractor or whatnot. How do they save?
Yeah. I mean, it's depending on the method, right? So if you're an employee, that means you're getting paid a W-2. Your options there would be if there's a 401k plan that you can participate in, max it out, right? There's no reason that you don't. Yep. And if not, and they're not allowing you to participate, do the Roth contribution, and you probably won't qualify for Roth, so do the traditional IRA and the backdoor Roth conversion, right? Get money in that Roth bucket because that grows tax-free forever. Above and beyond that, then it's, taxable brokerage account. There's no reason why you shouldn't set up and have a taxable brokerage account and invest.
So let me summarize for the audience, because you threw a lot of really important things out there and some may not know what it is. And correct me if I'm wrong, right?
Yep.
So a 401k, if your employer has one, or if you set one up for yourself like a solo 401k, you're taking pre-tax dollars,
right,
and you're investing it into that, and then it grows tax-free, but then when you take it out at 62 or 65, whatever it is, you're taxed on that at that point.
Yep, okay. Correct. And really just one caveat
Please.
there. Most 401k plans have a Roth and a traditional option, which means you could do the tax-deferred method, or you could put it in after tax today, and it can grow tax-free. Now, again, this is why an advisor is important. Like, I'll recommend either of those options, but really it depends on your tax bracket today and what your tax bracket is going to be in 5 or 10 years from now, and what your tax bracket's going to be in 25 or 30 years from now, as to which bucket you should be filling up today. I think a lot of people get in the wrong mindset of, I should do everything Roth, everything Roth, everything Roth. That could benefit you, but also, traditional. And having some in that traditional bucket is also a good plan and a good strategy. And so really, I think working with your accountant or your advisor and making sure you're optimizing kind of both of those buckets. Sorry.
No. That was a great, no, it's not a tangent at all. No, I'm glad you made that clarification. And I think you hit on a couple of very important things, which is the strategies are there that everyone can use, but how you use those strategies, like the details within those strategies, are unique to each individual person.
Correct.
And I think this is a really important topic for people to hear, because I think a lot of people listen to, general podcasts, that are not meant for doctors, right? They're meant for, the person who works for GM or for Microsoft. And it's different than if you're a doctor working at an office, because some of those people don't have student loans. They don't have this other debt. Yep. Or when people go to these, Facebook, chat rooms and whatnot, and they hear advice, which sounds good, but it's not personal to them.
Right.
So they may not get the result, which I think goes back to your point. Talk to your advisor, right? And ask your questions, and then follow up with them and figure out, okay, what do I do? Right? Okay, so that was the 401k. So thank you for that clarification. Sure. The next thing you said was that, and I'm probably misstating this, so please correct me, but with a Roth, it's or a Roth IRA, it's after tax dollars, correct? And so it grows tax-free also.
Correct.
But when you take it out, because you've already paid the tax, you don't pay the tax when you take it out.
Correct, yep.
At 62, 65, whatever.
Grows tax-free, and it's never taxed.
Okay,
again,
and I just mentioned the Roth IRA. Is there another one you mentioned?
Traditional. So Roth IRA has income limits. Not everybody can contribute to a Roth IRA.
Oh, okay.
So if you're above certain income limits, and it's I don't remember the limits off the top of my head. I always have to Google them. But let's say 150,000 of income, if your AGI is that high, then you can't go direct to Roth.
Got it.
So what you can do is you can fund the traditional IRA, and everybody's limit is, if you're under age 50 is 7,000. So we can do 7,000 into the traditional or the Roth.
Yeah.
And if you're over age 50, then you get an extra 1,000 catch up, so you do 8,000. But basically, there's a IRS rule that you can convert your traditional IRA to a Roth. And if your income's above a certain level, when you contribute to the traditional IRA, you don't get a tax deduction for it anyway.
Right, because it's after tax dollars.
Right. And so you can do that, what's called the backdoor Roth conversion. Basically fund the traditional, convert it to a Roth, and it's like you funded a Roth anyway. So
you can do that every year? Or?
You can do that every year.
Oh, that's
now there are caveats there. If you have other money in a traditional IRA or an old 401k that you rolled to an IRA, it doesn't work. But again, it's another conversation that you should have with your advisor making sure that you can, participate in the backdoor Roth.
Can you double dip?
You can do both. So you can either do, you have a personal limit is 7,000, whether it's in the traditional or the Roth.
Okay, but you can do a 401k and a Roth.
Correct.
And okay, cool.
Yep.
Well, then that's great, because I don't know what the 401k limits are these days, but I think it's like 17 or something,
it's
right?
23, yeah, 23.5.
Okay, so if you put 23.5, let's say, in a 401k plus another 7 in a traditional or a Roth, then you're like at 30, which is fantastic, right? I mean, that's fantastic, and then from there it grows, of course, and whatnot.
Yeah, and compounding conversation comes into play, right? 30,000 this year in 7 years is now 60,000, and in 7 years after that is now 120,000, and
that's right.
So that's where you're really grows, building wealth. Yep.
And if you're listening to this podcast and you're a practice owner, there's a lot of other things you can do. And for some of you who have your own corporations and you're independent contractors, this is not an HR podcast right now, so we won't talk about misclassification. But let's say you're an independent contractor and you've got your own corporation, you can set up solo 401ks, and there's a lot of other cool things which we won't talk about now. But again, I think the messaging is talk to your advisor so that they can pinpoint a plan that's unique to you. Because look, at the end of the day, the reason we're all working as hard as we are is to create financial independence for ourselves and our families, and so to leave this money on the table when it's available is kind of silly. Let's shift gears a little bit, because we've been talking about the retirement side, right?
You want to talk about the coolest thing since sliced bread.
Exactly. You know it. You know it.
I'm just kidding.
So no,
I just wanted to throw that line in there.
Yeah, you did. I know. I bet Brett just won a bet or something. Yeah. But I want to talk a little bit about something that you guys are doing at Earned that we haven't really talked about publicly, because we only do it. We've only recommended it to our best clients. I know you guys talk about it, with only your best clients as well. And we're actually launching it here at the Dental Leadership Summit, and we're going to talk about it on stage. You and I are. But one of the things that I want to have you talk about is a couple of these tax minimization strategies. Okay, so let's talk about first, which we'll come back to, because I know you guys do it slightly differently, is tax loss harvesting. Okay. So can you tell our audience what that is? Okay. And we'll talk about how you do it differently and why that's special later. Or maybe we won't actually. We'll tease people and they'll have to come to the conference to hear about it. But tell them about tax loss harvesting. Like, what is it? How does it work?
Yep. So tax loss harvesting, in a sense, right, is you invest in the stock market, right? Let's say we buy the S&P 500 index fund today, and there's a tweet that goes out tonight, right? And tomorrow, the S&P 500 index drops by 10%, right? So we started out with 100,000. Tomorrow our investment is worth 90,000. What we can do is we can sell that. We call that tax loss harvesting. where we're going to sell our position in the S&P 500 index fund.
Sure.
We've harvested a $10,000 capital loss.
Yep.
We're going to reinvest, right? But maybe we reinvest in the Russell 2000 index instead. So it's a slightly different investment.
Right.
We get the 90,000 back in. But what that did is that realized a $10,000 loss that we can then utilize to offset a capital gain.
Right.
And why this is powerful is because all our practice owning clients are sitting on an asset that will one day trigger big capital gains, and that's their practices, right?
That's right.
And many are sitting on other assets like a building that they want to sell one day that will also trigger capital gains.
Yeah. Investment real estate, you know, commercial real estate, like you said, Airbnbs, like anything really.
Or you have a spouse that has, is a tech worker and has concentrated stock positions. I mean, there's lots of capital gains that sit out there. And so our goal is to really try to optimize yourself, on a future, on a forward-looking perspective of harvesting these losses, banking these losses. Now, again, let's be clear. We're not investing in losses. We want you to get market returns, right? But losses happen. It's part of the market.
Yeah.
And so if we can harvest those, save those for a rainy day or a future day, right? When you've got a big capital gain, we can save you taxes on that transaction.
Yeah, that's right. Yeah. So to summarize, tax loss harvesting is basically a trading strategy where when on a day-to-day basis stocks drop, someone, not you, but someone on your team is selling those stocks on behalf of clients, holding on to the loss while they reinvest in something similar.
Correct.
So that on the books, when they go to sell, like you said, their practice, a second home, an Airbnb investment, a commercial, they're using that loss that they've harvested and that accumulates against those long-term capital gains that they're maybe having to pay because they sold their business.
That's correct. Yeah.
And I know the secret sauce, we're not going to share it because I know it's our secret sauce, right? It's what differentiates, I think, that strategy with what, you can do to put it on steroids to actually have incredible returns in the marketplace. But so that's one very important thing.
Yep.
So that I think is important for everyone to know. So that's one. The second thing is these opportunity zones, right? And not a lot of people know what these are. Can you describe that?
Yeah, I mean, that's the way the opportunity zone credit works essentially is, let's say you sell, your practice, let's say you only have $100,000 capital gain. Well, let's say you have $1 million capital gain, right? You're going to pay tax on that $1 million. You can take a portion of that gain, let's say 100,000 of it, and you can invest in what's called an opportunity zone. So typically they're depressed zones across the country, right, that are looking for reinvestment, trying to reinvigorate the economy in that area. And what that does is that will defer that gain, right? And potentially, if you hold that investment long enough, you can completely offset that piece of the gain. So you basically donate your $100,000 gain to that credit. You sit on it for a number of years, and again, I think you can minimize your tax
taxes
there. Yep.
So you said one interesting point. Do you have to use the gain from an investment?
Not necessarily. I said the gain, not necessarily
it could be cash,
the gain. It's cash.
It could be
you're taking 100,000 of cash
and
from
put it in there
from your proceeds, and that just defers 100,000 of your gain.
Okay, perfect. And so just to be clear, everyone, these are opportunity zones around the country that, like Carson just mentioned, are depressed, as far as the federal government is concerned.
Yep.
It's, so you're not, it's not going to be, Waikiki Beach or, Beverly Hills, but there are areas in the country where, there are cities that they want to re-energize with investments. And that's where these are. And it's funny because, I've looked at these, for myself, and there's a lot of places that you look at and you go, wow, this really isn't, a terrible place,
right.
But because of the income levels and because of other things, there's there's an opportunity to invest. And so really, like investing in land, I think qualifies, right? Investing in commercial property in these areas qualifies. Really, almost any investment in those zones can qualify. And like you said, if you hold it for, I think it's 10 years.
10 years.
Right? 10 years, then you can offset those gains in the future, so you don't have to pay for that. Okay. So that's the second thing for everyone who's listening. Is there a third that you really like?
I mean, we've got other strategies on the tax side, Augusta rule, things like that we're utilizing. Obviously, for practice owners, that are doing marketing, we like to have you use your kids instead of stock photos, right? So you can compensate your kids and things like that just really are good overall tax strategies to help minimize those liabilities.
So for all of you who have seen me lecture all these past 20 years, if you ever see those slides with my kids' pictures on them, now you know why they're there. Now you know why. That's my secret. So that's great. So those are a couple of strategies. There's a lot more, obviously, but those also have to be uniquely thought through with everyone's personal financial situation. And I feel like sometimes people think they should only speak to an advisor if they're already wealthy or if they're already well on their way of building wealth. But as we talked about earlier, if they start sooner, right, as they're beginning their careers, yes, they may not be able to set up a 401k where they are paying all their employees their fair share and all that, because the reality is there's not that much cash flow in the first couple of years, but it doesn't mean they can't save or they can't set up something.
Yeah, there's actually a slide we're going to show tomorrow, and it's if we can save you 1% on your tax return through investing, right? Yeah. So 1%, right? It's not a big number.
Right.
That can add 11 years to your retirement plan.
Oh my gosh.
So
really?
Just the compounding impact of saving 1%.
Wow.
And so, it's just a powerful message that, man, I start early and invest appropriately, like using tax loss harvesting, which you can use some of those capital losses against ordinary income every year, right? It's not a big number, but it helps, right? It helps on that tax savings side of things. And so anyway, you don't have to be wealthy to start, speaking to an advisor, building a financial plan, and optimizing kind of the longevity of your wealth.
Of your wealth, yeah. So as we kind of get to the end of this episode, can you tell a story of someone who maybe made an emotional decision with their, wealth or their savings or whatnot that just sort of stands out to you that maybe you want to tell the audience so that they don't repeat it? Because I as you know, we're big in teaching, and I think a part of teaching is telling stories so that people, whoever's listening it might resonate with them, right? So is there one example?
Yeah, I mean, with me, emotions come into investing, right? Nobody ever wants to buy at the height of the market and sell at the low, right? And so I think the biggest lesson I've learned through investing is, look, nobody can time the market, right? So you've got to be able to manage the risk so that you can sleep at night. But because if you look at the market over the years, it's always on that trajectory up, right? So if you can just weather some of those down dips, right, you'll be able to ride that out, and ultimately you'll be in a better position in the future. And so really it's the emotions of, hey, I bought today and the market's crashing. Like, I need to get out of the market. Like COVID was the prime example. If you look at the stock market from like December 31st all the way till, March, April, every week it was going down. And having that phone call with clients like, look, I understand that the markets have gone down and I understand your portfolio's down, but I still have areas I can draw to give you cash if you need it. We need to ride this thing through, right? At the same time, optimizing and doing tax loss harvesting reinvesting. We put our clients in really great situations coming out of COVID, being able to ride that market, not selling at the bottom. Because what happens if you sell at the bottom and the market starts to turn back up?
Right.
It jumps really fast and you miss those biggest days. I mean, there's key facts out there that if you miss like the 6 biggest days of investing, it cuts your returns by, it's an astronomical number.
Yeah.
And so, you just can't miss those big days. And you never know when they're going to happen. And so
that's a great, actually, I didn't think about COVID, but you're exactly right. I mean, talk about extreme fear.
Yeah.
Right. And you're right. People who sold, and we can't blame them because we were all scared. We all were scared.
Yep.
We didn't know what was going to happen to our businesses, to our lives, to our families. I mean, nobody knew anything, quite honestly, when you think back to it. But if you had sold, then you would miss the entire upswing through the rest of 2020, 21, 22 that happened.
Yep.
So that's a great point. But again, it goes back, I think, to what you said earlier. Listen to your advisors and be really smart about that. So yeah, no, that I think that's a great way of ending the episode, because fear always drives us, right? And sometimes it drives us to do more, right? Fear of failure sometimes drives people to succeed and be, gangbuster and build businesses and things. And sometimes fear works against you and you do things that you shouldn't do. So if anyone who's listening is interested in getting in touch with Carson and his team at Earned Wealth Advisors, his information is in the descriptions below. So please feel free to reach out to them. They do tax, right? And which is, tax returns, bookkeeping, all of that. They do wealth advising, right? What else do you guys do?
We recently acquired a firm to do disability insurance. So awesome. A really cool story there, a doctor that was heading out on disability and realizing that she didn't have the right insurance, right? And so just making sure, walking other doctors through so that they don't have the same mistake.
Yeah.
And so that's
awesome.
Yeah.
So disability insurance, other insurances too, I'm sure, right?
Yeah. We can help. Yeah, we can help provide you or give you direction on that front. But really, it's kind of anything that a doctor needs, right? That's our goal, right, as a company. I think our CEO, John Clendenning, kind of founded Earned on that basis, that we've got people out there looking for our well-being and our health, but who's looking out for their well-being and their financial help, right? And so that's really the why we were born is so that we can help doctors kind of get healthy on the financial
on
aspect.
all fronts, because you got a
student debt. I mean, that's another
debt,
one.
The whole thing, and having it all under one roof just makes it, I think, so much easier. And of course, you've got HR for Health for the HR compliance, so that you don't get sued and you don't lose money there. We've been talking about tax minimization and all those things, but a loss is a loss, right? Whether if you end up paying an employee $100,000 or lawyers even more to defend yourself, then you don't have those funds to invest with you. And so, of course, if you want to learn more about that, please, reach out to HR for Health. But all of Carson's information is below. And one final thing, if you want to learn more about this tax loss harvesting and how you might be able to sell your practice or some really other, awesome assets that you have, commercial real estate, Airbnbs, second homes, whatever, and you want to do it without paying or minimizing your federal income tax, talk to Carson, because he'll go through that in detail with you.
Coolest thing since sliced bread.
Coolest thing. Awesome. Thanks for being on, Carson.
Hey, I appreciate it, Ollie. This is great.
Yeah, thank you again.
All right, thanks.
Bye, everyone.